Welcome back, everybody. What is going on? So excited to be here with you guys today. Yesterday, we tried to jump on this live and talk to you guys about life insurance, but we had a little bit of technical difficulties. So I'm excited to be back here today. And hopefully, my video quality is coming across exactly how it should. My volume is coming across exactly how it should. But if it's not, let me know in the comments and we'll get that fixed. Excited to be here with you guys today. Before we jump into today's topic, I just want to thank everybody who has subscribed to the YouTube channel. For those of you guys who are new to my channel, what we do is we talk about tax strategies on this channel. As a licensed enrolled agent, I work with a lot of entrepreneurs. I work with a lot of W-2 taxpayers. And the one common thing that I see in the tax and accounting space is that there is just a lack of people teaching about taxes and how to leverage the tax code. Am I right? So if you're on this channel today, it's because you care about taxes, you care about building wealth, and more importantly, you care about aligning yourself with professionals who can help you achieve your financial goals. And I hope to be that person in your life. So just want to say thank you if you've been a follower of mine, subscribed to some of our videos and liked any of the videos that we've posted. What I'm going to do today is I'm going to bring up my great friend, Caleb, somebody who I met about 3-4 years ago, and we've established a relationship around the topic of life insurance. At the time, I was a lot younger, so life insurance was still new to me, but I've always known that life insurance was one of those well-kept secrets that the wealthy have always leveraged. And in today's video, what I want to do is give you guys a comprehensive understanding of life insurance. I want to take it all the way back to the beginning to understand the basics of life insurance. And then we're going to allow for Caleb to go deep and tell you guys how some of the top 1% earners are using life insurance as a wealth building tool and for tax savings. And so I'm super excited to bring up Caleb. I'm going to bring him up right now. Caleb, how are you doing today, man? Thank you so much for joining us.
Man, it is a pleasure to be on here. I'm super, super excited, and I'm one of those weirdos that love talking about life insurance because when it's set up and used properly, man, it takes entrepreneurs and investors and what they're able to do with their capital to the next level. And so it's a pleasure being on here, man.
I'm super excited to have you on here because you get just as geeked up about life insurance as I do about taxes, and you kind of wear it like on your sleeve. And I'm super passionate about the tax code. I put out videos just as much as you put out videos as it pertains to life insurance. So it's really exciting to bring you on to our channel today. Caleb, what we want to do is we want to have a good understanding of life insurance in total. Why do people even consider this? You know, and when I say we, a lot of young entrepreneurs, we've heard a lot of mixed reviews about life insurance. We've heard that it's kind of scammy. It's a waste of money. A lot of it just goes to, financial advisors. So what I want to do today is I want to turn it over to somebody like you who's a specialist in this and kind of educate my audience on why life insurance might be a great tool for wealth building and an asset, as you would call it.
Yeah. So I want to just go back to the very beginning. I got a job at a bank when I was 17, and I ended up taking over the bank's investment department when I was 19 years old. Okay, one of the youngest people to have that responsibility. I'm in the corner office of the bank. I look like I'm 15 years old at the time, and I asked a simple question that every single person probably is very curious about. It's like, what is there a better way? Is there a better way to help people with money? And one of the things that I became obsessed about is this concept of efficiency. I know you and I have talked a lot about efficiency, and the definition of efficiency is removing any friction to get to your desired result. So in other words, if you know where you want to go, remove any friction to get there. That's the beautiful thing about tax planning and
Yep.
tax strategy is like there's so much friction in overpaying on taxes. That's an example of removing friction, stop overpaying in taxes, you're able to fund what you currently want to do. And so I asked a simple question, is there a better way to help people with investing, with helping people take more control of their wealth? And I started learning a lot about life insurance, and I learned about what banks were doing, about what the ultra wealthy were doing, and I learned that a lot of people that were pitching life insurance as an investment, you should run. There's a lot of people that are saying this life insurance is going to be better than your 401k. It's going to be better than real estate. It's going to be the best kept secret. Be very, very cautious because if anyone's pitching something as this best kept secret, just be cautious. But what I realized was life insurance is not an investment. That's the biggest mistake people make. But it's what banks and the wealthy and corporations look at it as is they look at it as a paper asset to store and use capital. They use it to store capital because when set up and used properly, it will grow with tax benefits. You can use your money tax free and you get to pass it on tax free. It also has privacy protections and so many other core benefits from a standpoint of having your money storing your money. But then the other benefit is you can utilize your capital throughout your life while it continues to grow. Some people call this infinite banking. Some people call this cash flow banking. We're going to dive into all of this because within all these things, there's a lot of misinformation about using your money in more than one place and being your own bank. Like that's a cool phrase. But at the end of the day, when I realized that life insurance, and this is a writer downer, when life insurance is set up and used properly, it gives your dollars more than one job. It literally gives your dollar the ability to work for you 30, 40 years from now, and gives you the ability to use your money throughout your life, and protects your family, and gives you options for the future, and allows you to save more money. Because a lot of entrepreneurs and investors have this dilemma of, should I save more or should I invest? And life insurance, when it's set up and used properly, which we're going to dive into in a second, gives you the ability to have both. And when I learned this, I was just like, we need to share this with the world. And so that's when I wrote the book, The And Asset, started betterwealth.com. And we have clients in all 50 states, and we try to share this message of not don't invest in life insurance, but store and use your money in the life insurance. And when set up and used properly, it becomes the biggest no-brainer that you can have at the foundation of your life.
Okay. You just blasted us right there. Okay. We got to peel this onion back. I first just want to have my audience understand, like, how did you get into this space because you're young to me. How did you get into this space at such a young age, and how are you finding success? Obviously there's people that need this. So who are the people that, really would value life insurance and be able to leverage it?
Yeah. So two questions. How did I get in this space? I'm calling from Nashville, Tennessee, but I grew up in central Wisconsin, the oldest of 6 kids. My parents are not in space, which is really important. It's like, bookmark that. Worked at a chicken farm, started reading some books, and then got a job at a bank when I was 17. And that's when I just decided I'm going to do everything in my power to learn everything I can about how people interact, how money works, and just how the world works. And so I'm the teller. I'm like, I know your social security number. I'm like helping people with their money. I'm attending our marketing and department, and I'm writing radio ads. I'm in our loan division. When I was 18, I worked in our investment department, because a lot of banks have like investment departments.
How did you
And then
get
when I
into
was
the
19 years
investment
old, the guy that was running our investment department left, and I then took over the corner office. I had my own bank phone, own bank computer, and I met with over 300 clients. And it was that day that I made a commitment that I was going to do everything I can to help people see and reach their highest potential. And that's when it's a blessing in disguise, because I didn't have a direct mentor. I wasn't at like there's a lot of average people out there. And so because I had to go seek out people, I grew my network, and I started meeting with people that have worked directly with Robert Kiyosaki, and people that were like all over the country that understood like how the game works. I ended up driving to insurance companies and sitting, learning with the actuaries and stuff, mainly because I didn't have a direct mentor, but I created my own mentorship. And looking back, I'm just so incredibly grateful, because I went to school for business and finance, but I had a 3-year crash course learning so much about how the wealthy think about money, how they think about taxes. That's why I love you, dude. And I realized that a lot of people are having conversations about real estate and investments and all these things. Very few people are talking about life insurance the way that I think they should be talking about it. And the home run conversation is, it's not an or. Don't do this or that. If anyone's saying do this instead of that, run. But the person that understands how it can be an and as a part of your portfolio, enhance everything else that you do in your life, that's when I was like, there's something here.
I like this. All right, so let's dive in. I want to understand the game. My audience wants to understand the game. What can you tell us about life insurance that we can start doing right now? Or what can you tell us that other people are utilizing life insurance for? Let's dive in. Do you want to show screen?
Yeah, and let's share. I have a couple slides, and what I want to do, and any of you that know how I operate, it's very, very important to me that we start from the basics, because it's easy to maybe throw out a phrase, but like I want every single person watching this to have a very comprehensive guide of like how this works. So when I talk about life insurance, one thing that I talk over and over and over and over again is it has to be set up and used properly. It has to be set up and used properly. And by the end of these couple slides, you will understand exactly why I say that. And it's easy for me and Karlton to say, hey, the wealthy use life insurance. That doesn't mean you should go and buy life insurance from an average person. Okay, that's all I'll say there. So what is life insurance? Life insurance is a contract. Okay, so you might want to write the word contract, because that's all it is. It's a contract between you and an insurance company. What kind of contract is it? It's a unilateral contract, pretty much meaning the moment you enter in the contract, the insurance company is on the hook for life for these certain promises. And it's a unilateral. So as long as you keep the contract good, you're good. So you're not on the hook for life. The insurance company's on the hook for life. And so what we really need to double tap is, what kind of insurance companies should we work with? and what kind of contract should we design. So when it comes to the insurance company, let me just click my screen here. When it comes to the insurance company, we want to work with mutual insurance companies, meaning we have part ownership. So when you look at the thousands and thousands of insurance companies, there's the difference between stock, meaning the profits go to the shareholders that don't necessarily need to be policyholders. Mutual essentially means it's like a credit union. You are part owner if you have a policy with that company. So we're looking at a company, we want to work with the companies that are mutual, meaning we are part owners in the company by just entering into that contract with them. We want to make sure that they have good ratings. We want to make sure that these insurance companies have been around for over 100 years. So we are working with companies that have been around for a very long time, have a ton, they're very stable. They're not like banks that are failing left and right. And we also want to make sure that we're have a contract with the companies that we can participate in the profits, because insurance in general is very profitable. So you want to make sure as many of those profits flow to you for the rest of your life. So that's the insurance company. But more important is we want to make sure the contract is maximally funded. What I'm going to share in a couple minutes is the same contract, how we specially design one, and the radical difference you'll see in the numbers. Okay, so when we talk about contract, there's term and permanent. There's a lot of questions about should I buy term and invest the difference. All I'll say is term is a temporary contract. There's a lot of people out there that say buy term and invest the difference. We're going to be talking about permanent because I'm a fan of save money in an overfunded permanent and invest the difference. So we're talking the same. We're talking the same thing. I just believe when set up and used properly, you will actually have more efficiency with permanent. But the only difference is permanent is going to last your entire life. Term is going to be temporary, and majority of term insurance doesn't pay out, mainly because it's a good thing that you don't expire or die during that time period. But the whole concept, and this is the thing that I want to get across, is the concept here is when we're specially designing life insurance, we want as much living benefits as possible, meaning we want as much cash as possible. We want as little death benefit as possible. So that goes against everything that you learn about insurance. Majority of the time when we talk about insurance, we want as little bit of premium. We want to pay as little bit as possible for the maximum amount of insurance benefit. Think about your car insurance or your home insurance or any other type of insurance. You want to pay as little as possible and get the most amount of coverage. When we're talking about insurance, this is why it's very important. It's insurance because of tax reasons, but we want to do the exact opposite. We want as much cash because that's what we care about. And we want as little insurance as possible, but we need enough insurance to make it insurance so that we get special tax advantages. So when set up and used properly, these are some of the pros. When you set up and overfund your policy, you'll have it's safe, way more safe than the average bank. You will have liquidity, I mean you have access to your money that you can use from day one. Your money will grow for the rest of your life. You can leverage it, which we'll be talking in a second, where you can use your money while it continues to grow. It has special creditor protections. It's private, which is really key. And then when set up and used properly, it will grow tax-free. It can be used tax-free, and then it gets passed on tax-free to the next generation. Hence why a lot of people call this the rich person's Roth. A lot of wealthy people stuff hundreds of thousands, if not millions of dollars into this because it works very much like a Roth, but they have more control. They can use their money to invest in all their other things while their money's safe, protected, and private, growing, and will get passed on tax-free to the next generation. Like, do you realize save money via tax strategy, put it into life insurance, and invest? That's like the 1, 2, 3 punch to this game. But there are some cons to this, and if anyone's telling you these are all the good benefits and there's no downfall, like, be very, very careful. So here are the 3 cons. Number 1 is you do not get a tax deduction. Just like a Roth, you don't get a tax deduction. So we're not getting a deduction for a future deferral. The second con is when you enter into a life insurance policy, very much like a retirement account, you don't get all your money. You can't access all your money immediately. So this is not for every single penny for you to put in. We have to understand that it might take a couple of years to have access to all the money that we've put in. And then the third aspect is because this is insurance, not everyone qualifies. We have people in their 80s that do this, but some people in their 80s are not super healthy. And there's some people that have had tragic events that have happened from a health standpoint. And just know, if this is you might not be able to get life insurance on your life, but you can still get the benefits of the cash. You just might need to find someone else to insure along the way. All right. So any questions so far on that?
I think one question that I have that somebody's asking is, how is it more safe than the banks? I guess that would be a good question to kind of stop and ask. Because when people think about, where they want to park their money, they want to get a return on their money, but they also want to make sure that they do still have somewhat access to the money. So how is
Yeah.
parking money into insurance and, like you
Yeah.
said, more like
Yeah.
a permanent policy?
Great question. So, both banks and insurance companies have insurance plans. Okay, the FDIC insurance, and then insurance is regulated by the state. The biggest difference is insurance companies have dollar for dollar ratio of their debts to money that's actually on hand. Meaning, if we dissolve the insurance companies that we work with, and they had debts of $100, they have like $110 for every $100 they have to pay out. Banks, on the other hand, work off of what's called fractional reserve lending, which means that they have less than 10% on hand. So if there's a bank run, they don't even have the money to cover it. So the step number one is insurance companies actually have the money to cover it and are heavily regulated from a standpoint of that because they're in the business of insuring catastrophic deals. Like they need to have their act together. And banks are working off of what's called fractional reserve lending. So that's a big step. Then the second thing is banks are lending out and their money in motion. Insurance companies still have blocks of business that they're investing in, but they have massive amounts of liquidity. And there's other insurance companies that back them as well. So from a risk standpoint, insurance companies will be the last institutions that fall. And everyone is in agreement to that. Very like majority of people will agree that insurance companies is the safest institutions to store your money, especially if it's mutual companies that have been around for over 100 years. They have billions and billions and billions and billions of dollars on reserve. And that's just they do that because they're in the business of 100 to 200 years from now.
Yeah. It's pretty eye opening when you find out that banks are actually taking your money and then going and parking it in insurance policies. Can you
Yeah.
talk a little bit about like why banks would do that versus just keeping the money liquid inside of the bank accounts?
Yeah. So let me show my screen here quickly. So obviously presidents on both sides of the aisle use it, but check this out. Over 3,200 banks in the United States today, get this, use what's called bank-owned life insurance. Bank of America has over $22 billion of their safest assets in bank-owned life insurance. Wells Fargo has $19 billion of their safest assets in life insurance. The reason they'd have this is banks have different regulations, but at the most basic form, they have certain really, really safe assets that they can only put a few places, and insurance gives them the safety of having your money in cash, gets you a better rate of return, but then also you're able to lend against it. So they're able to continue to lend against the asset, have the benefits of insurance, and they get to use it to lock in key people. That's why a lot of people have VPs, because when you're a VP, you qualify for these type of plans. So they use insurance, just like we teach people, multiple different ways. They get an insurance policy, they're able to lend against it, they're able to get a better rate of return, and they're able to lock in key people all with one paper asset.
Yes. So the loan part, lending against the asset. Can you talk a little bit about that? The
Yeah,
basics of
absolutely.
lending.
Why don't you unshare my screen and let me get to there for a second? Because I have a drawing that is going to be really key here. This is all of you that know me, you know that I'm a nerd when it comes to all this. So you can share my screen again. So when we talk about lending against policies, and again, we talked about max funded. So when we max fund a policy, we're getting 85 or more % cash value in the first year. Like that's anytime someone's seen a life insurance policy, usually you see like zeros in the first couple of years. We have massive liquidity. Like it's incredible policy designs. So when we talk about when you're using your policy, we want to think about it more like a credit card versus a debit card. Okay. When you go and spend money on something that you're already going to purchase, majority of us can agree that a credit card has more security and gives you more benefits by the same purchase. So when you're purchasing something, you have to decide, am I going to purchase this? But then when you decide that, then we can all agree that credit cards create more protection, security, privacy, and you get these things called points. And Karlton, you and I have done some pretty cool things with points. Okay. So when I think of our policy, I want you to think about the credit card aspect. When we're talking about using your policy, I believe long-term, you're better off using your policy than paying cash for things. And it's the concept of debit versus credit. So what do I mean by that? when you look at people like Walt Disney and Ray Kroc and my good friend Garrett Gunderson, who wrote What the Rockefellers Would Do, and my good friend Justin Donald, who wrote Lifestyle Investor, they all have something in common. All these people, land flipping, all this, they all have something in common. They all use their life insurance to purchase certain things, and it's because the life insurance is at the foundation of their life. It's a game changer. So when you fund a life insurance policy, your money will grow for the rest of your life. That's what this first beautiful drawing of mine illustrates. When you have your money put in, it's going to grow without taxes, without fees for the rest of your life. Not till 65, not till 75, for the rest of your life. And when you pass away, that death benefit is going to be even greater, and it's going to get passed on to your family next generation. So that's number one. Number two is when you want to use your money throughout your life, because your greatest financial need is using money, we could take that money out. But what happens when you take money out of compounding? You're killing the goose that's laying the golden egg. You're saying this insurance is amazing, and I'm going to take that out, and I'm going to have less amazing. So if insurance gets you all these benefits, not just rates of return, but all kinds of benefits, and now you can borrow against it, you can keep your policy continuing to grow and give you all the benefits to your portfolio. And what you can do is you can borrow against the cash that you have built up there. And this is what a lot of wealthy people do, borrow against their assets. And then you can buy an asset or a liability. And so what this could look like is if I have $100,000 in my policy and I want to invest in a real estate property, or if I want to invest in a business, instead of taking that money out, I can borrow against maybe $30,000 or $50,000 worth of my cash value. My policy is going to continue to get all the benefits because I'm borrowing against it. And now I have capital to invest in an asset, and hopefully that asset can get me even greater rates of return. So now I have a dollar literally doing two things rather than one. And so the reason I write liability here is there's some people that teach that anytime you use your policy, you're going to get wealthy. And that is not true. There's people that use their life insurance policies to go buy dumb stuff, and then that dumb stuff is not going to make them wealthier. Yes, your policy is continuing to grow, but buying dumb things doesn't necessarily get you farther ahead. So that's the big thing that I like to break down. And this is a really good picture for our clients is when you fund a life insurance policy, we build what's called an emergency fund. I believe everyone should have their emergency fund built up. And then once you have money above your emergency fund, that now we have an opportunity. And this opportunity fund gives us the ability to invest in whatever we want to invest in. And I see our life insurance as kind of like our personal fund. When I put money into it, I'm looking for all kinds of opportunities to reinvest. And so yeah, that kind of answers your question there.
Yeah. Yeah. Right here is a really great illustration, right? Because if someone asks me like, where are you going to put your money, Karlton? Like, first I'm going to put my money like into my business. That gives me my biggest return. Like I'm going to invest my money into my business. Then real estate comes next because I'm getting the second biggest return with my real estate portfolio, the tax benefits. Then I have my own personal investments. And then next is like kind of like investing in like myself, like building up this like savings account in my life insurance policy, knowing that if I need to, I can borrow against it. And that's the concept that you're talking about with the whole and asset. Like in addition to the opportunities that I'm already taking advantage of, I understand that. Can you talk about the concept of compounding? So let me make sure I can do this correctly. I have a little description here. So you said let's just say I had $100,000 built up in my policy. I could take out 30,000. That's what I think you said earlier. And I can invest that into things like real estate, crypto, back into my business. And those things might get me like a 10% return or greater, right? Or greater. Yep. But what about the fact of this 30,000 that I took out? How does that impact the 100K that I had built up? What happens with this 100K? Does it go down to 70,000? Can you explain that piece?
Great question. Great question. So I'm going to speak to two things. You said something earlier about business, real estate. And the beautiful thing about life insurance is, this, it doesn't replace the or decision. You can have that. You can funnel all your money, your savings to life insurance, and then invest in real estate in your business. And now you're getting your dollars doing two things rather than just one. To answer your question on the other side, from a standpoint of what happens if you have like $100,000 in your policy, you're going to get the benefits of your 100,000 growing the rest of your life and all the benefits of life insurance, which I can go into in just a second. And then when you borrow against 30, you're still getting the benefits of 100,000, but now that 30 is you can reinvest in other things. And there is an interest charge we call control costs to that 30,000. And so the big thing is you want to make sure if you're borrowing against your policy, and you're paying interest of like 4 or 5%, you want to make sure that the activity that you're putting your money into is getting you greater rate of return than that. For instance, you wouldn't want to borrow at 5 and then put your money in a 3% CD.
Right.
That's not great. But if you put your money at 5 and earn 12% in an investment, now that activity over there is getting you 140% rate of return, and your policy is continuing to grow whether you've touched it or not. So that's the beautiful thing about your dollars doing two things rather than just one.
Talk about the policy continuing to grow.
So why don't you share my screen? We're gonna get right into the numbers, and for those of you that are analytical nerds, you're gonna love this, and for those of you that aren't, just listen to what I'm saying. So this is a policy. This is like a typical max funded policy. There's nothing special about this, but you can see the rates of return here. You can see when you fund it, the first couple of years, you don't have a positive rate of return, meaning if you cashed out in the first couple of years, you're not winning anything. But Karlton, over 30 years, this policy, and this was done over a year ago, so in lower interest rates, it shows 4.5%. Meaning what this means is this policy is going to get you 4.5% every single year without a down year, including the negative years when you look at over a long period of time. So what we do is we have to ask the question compared to what? And when you factor in taxes, when you factor in fees, when you factor in costs of insurance, what we show is if you take someone that has 3.5 or 4.5% internal rate of return long period, they have to earn 6, 7, or 8% every single year just to keep up with the boring old life insurance, because you have to factor in other things like taxes and fees and other things. And so we're not saying that life insurance is getting you, and remember, it's not an investment. We're not trying to compete with investments. But my question is, where out there long term can you have liquidity and control over your money and get anywhere near 4, 5, 6, or 7%, all for private and protected and creating options in the future? So the whole concept is life insurance is not to replace investments, but it will outperform any safe liquid account long period when you factor in taxes, fees, and other things.
Yeah. So break this down for us. So internal rate of return, I want to make sure everyone understands that that's watching this today. And then you're covering the tax rate. So, and then the fees are factored in here. So can you break this down just simple as you can?
What we showed is what I just showed on the last page is an internal rate of return of 4.5. What does IRR stand for? Internal rate of return stands for actual rate of return. This is after commissions, everything. This is what you can actually expect to find in your policy. We like whole life because it's less moving parts, and we're not trying to pitch this as an investment. It's a place to store capital. So what I did is I said, okay, a 4.5, and now we're seeing like internal rates of return of like 5 and sometimes 5.5. We're just saying, to be conservative, Karlton, we're going to show 3.5% long-term internal rate of return. So a lot of people look at that and say, okay, there's nothing special about that. And we're just looking at rate of return right now. We're not going to look at all the other benefits that life insurance gives you. We're just going to look at rate of return. But what happens when you make an interest rate in a savings account? You have to pay ordinary income tax on that. Now, whether it's 30% or whether it's lower than that, depending on where you are, the point is, if your money is in a savings account, you have control over that, but you still have to pay taxes on the interest that's earning. So even if insurance is set up and used properly, if you compared an account, a savings account versus an insurance policy, you have to earn more money in a savings account just to keep up with the boring old insurance, because the savings account has taxes, whereas insurance doesn't. Does that make sense?
Yep, 100%.
So then now what we have to do is now we have to look at any other drag. Remember, we're including everything in this internal rate of return. So now we factor in what happens if you put a 1% fee. A 1% fee could literally represent anything. It could represent an actual fee. It could represent actual costs of doing business. And now we have to earn over 6% in a different account just to keep up with the life insurance. And then some people say buy term and invest the difference. And when we factor in the cost of term insurance, remember that's temporary insurance. Now, in this scenario, just looking at a 3.5%, which is already super conservative, you take someone to say you need to earn 6.9% every single year to just keep up with the boring old life insurance. And remember, insurance is not an investment. You have total control, and insurance has all kinds of other benefits that doesn't just represent the 6.9%. My question to you is, even with today's high interest rates, you can't even touch this. And this example is being used 2 or 3 years ago when savings accounts were getting no percentage. So this just shows you that when we're not looking at this as an investment, but we're looking at this as a place to store and use your money, it's a phenomenal paper asset to store and grow your money. Use it, And then there's so many other benefits that we could get into that there's so many other benefits that you get with having life insurance in your portfolio versus not having it in your portfolio.
Yeah. So this is a great illustration right here. So you're talking about having like a conservative 3.5% internal rate of return, but you're factoring in right below that interest rates or interest on the savings account that you might have. And if you're factoring that at a 30% tax rate, then you would need to earn about 5% just to keep up. Is that what you're saying?
Yes. That's
Okay,
what I'm
great.
saying.
And then right beneath that, you're also factoring in 1% fees. So now we're talking about 6% that just to keep up. And then if you're factoring cost of term insurance, which is what I'm assuming what we hear a lot in the space, invest the difference. Now we're pushing close to 6.9%.
And I'm starting with a 3.5% internal rate of return. And on policies that you and I have, they're more like 5% internal rate of return. So you can do the math. It's a lot higher.
Yeah, this is extremely conservative, obviously. This is extreme. This is obviously extremely conservative.
Yeah, but the point that I want to make is even if it's extremely conservative, the rate of return is just one element. There's so many reasons why insurance benefits you. Rate of return is what everyone wants to talk about, but it's only one element. I mean, we could look at people that have insurance in their portfolio versus bonds can create more cash flow in the future than the people that just have equities and bonds. Why? Because insurance works a lot like a bond, has special tax advantages, has a lot less volatility, gives you a lot more future opportunities for the future, and just allows you to get more cash flow in the future. So it's just one of those things where, like, what's the rate of return of having more income in the future? It's hard to measure, but those are the kind of things that we're trying to educate people on. That's why it's called the and asset, because when set up and used properly, it creates and is better than or.
Yep. I like this. This is starting to all pull together. And part of the reason why I get why you titled your book, The And Asset, and congratulations on that. So the next thing I want to talk about is some of these tax benefits. A majority of my followers are here on this channel because they're trying to grow their wealth and remain as tax-free as possible. Can you talk about the differences between, having like a Roth IRA, which is, only going to keep us at about 6,000 that we can put in there every single year. My audience is fully educated on that. But how is this similar to that, but gives me the control? Because I can't touch my Roth until I'm 59 and a half. I got at least 30 years between here and there. So talk a little bit about that.
Yep. So Roths are great. And obviously you teach on this channel different ways to do backdoors and all that kind of stuff. So the point is, think of Roth as a wrapper. And the wrapper is essentially saying, it doesn't matter what you're investing in, but you're not going to pay money. You're not going to get a tax deduction, but your money, once it's put in, can grow tax-free and you can use it tax-free. And then there's you have to wait till 59 and a half to get interest and all that stuff. So there's a couple things from a standpoint of lack of control, but we can all agree that Roths have more control than like a typical traditional IRA. Okay. So the big difference that I would say from life insurance to Roths, and I think Roths are amazing, by the way. The big difference is when it comes to insurance, you don't have any of the regulations from you have to wait till 69 and a half to use more than what you've put in and all that stuff. That's number one. Number two is it has a tax-free income or death benefit tied to it that a Roth doesn't. Step number three is the way that we design it, we're trying to teach our clients on how they can use that money from almost year one. So you fund it, you're continuing to fund it, but then how do we use our dollar in more than one place? In a Roth IRA, it's possible, but how many people do you really know that are teaching you to fund Roths and then borrowing against it? There's almost none, because your money's in an investment. And to be frank, if you're already investing your money, you want to be careful not to over leverage your investments, because we've seen the market go up and down. And the last thing you want to do is over leverage an asset that could then dip. Why are we fans of leveraging life insurance? Because it's not going to dip. It's like there's some built-in guarantees that just make this really stable. So I look at a Roth as an investment, and I look at life insurance as a place to store capital. We have had people that have put money into life insurance and then have funded certain things using Roth IRAs, and they get like 2 tax benefits, just like people that put money into life insurance then use some of their money to go buy real estate. And with real estate, this, you get, all kinds of tax benefits. You get to use leverage and all those things. They use their life insurance and real estate and have that be a 1-2 punch. And so that's the biggest differences of a Roth versus like overfunded, max funded life insurance.
Yeah, I like that. So you said Roth you do as an investment, life insurance is a place to store capital. and it gives you the opportunities to do other things too, like reinvest immediately. So can you talk to me
Correct.
about some of the things that maybe you do with your policies? Are you utilizing them to borrow against them? Are you not at the point where you are borrowing against them? What does that look like in
Yeah.
for you?
I remember the first time I used my policy was when I was still working at the bank, and I wanted to go to Guatemala for a missions trip. And I remember using my policy and to fund this trip. And I remember thinking how cool it was when I was on the plane back to the United States to be like, how cool is it that I'm starting to save for the future and I'm using my savings to create experiences. And it's like that for me, like I can't look at Guatemala and say this made me a greater rate of return, but anyone that knows me knows that like missions and helping people are really, really important to me. So all that to say, that was the beginning, but I used it to finance the book, The And Asset, which has sold over 15,000 copies and opened up so many doors. I've used it to open up other opportunities to bring on people. I look at it as a way to fund businesses. There's multiple businesses that we have ownership interest in. Why? Because I have access to capital. How did I have so much money early on to save? Is because I was starting a business. I didn't want to lock up my money in other places because business is a roller coaster. So I would fund it into life insurance, have massive liquidity, but then also be able to use it as a place to weather the storms. And quite frankly, dude, right now I'm sitting on hundreds of thousands of dollars in my life insurance policy, just kind of waiting, because I think there's going to be a lot of opportunities in business and a lot of opportunities to come. So I'm not just sitting my money in a savings account earning no interest. It's there, but I personally like a lot of emergency funds, and then I also like to wait for like crazy opportunities. I don't want to make a 12% investment right now. I want to, if I'm going to lose a little bit of liquidity, I want to make sure that I can get something that's like can double my money. And so I'm in the waiting game right now, but we've had Better Wealth for over 6 years, and the policy has weathered a lot of storms and allowed us to really hire people like during the pandemic and stuff that a lot of people are afraid. We had capital, so we got to make some things happen when a lot of people just didn't have the liquidity.
Yeah, yeah, you can weather some pandemics when you're planning correctly and um, putting your money in places to store capital that are earning you returns that are almost guaranteed. Can you talk a little bit about that guaranteed part? Because that when I learned about that, that was like a bigger motivation for me to make sure that I was contributing
Yeah,
to this monthly.
there.
Can you talk about that piece?
Yeah, and so this is what I'll say is there's two type of, and this I wouldn't show the screen right here. There's two types of insurance policies out there. There's policy number one is what's called whole life, and policy number two is what's called index universal life. Now they're both permanent contracts. Whole life is more built around guarantees. Majority of people would say whole life is where you have ownership stake in the business, and that's like a longer period, like I'm going to store and use for my money. I prefer more whole life because again, I don't look at life insurance as an investment. I want to put my money, I want lots of liquidity, I want to know what's going on, and I'm not looking at it as a way to like beat the market. I'm like I want it to store and use my money, and I don't want any surprises. There's another contract out there called universal or index universal life, and this is also a permanent contract. They use the same tax-free wrapper as it relates to, your money when set up and used properly will grow income tax-free. You can use your money tax-free, but instead of having built-in guarantees with a dividend, you're now looking off of an index. And the technical version is they're taking the money that they would pay you and just buying call options and saying, hey, if the market goes up, we're going to give you a higher crediting rate to your policy. And if the market goes down, we're going to credit you zero. So what they say is there's higher upside and little to no downside. Obviously, there's the cost of insurance and stuff. So there is some of that can happen. And some of the benefits of index universal life is over time, it has potential of being greater, but it also has potential of having a lot more variables to it. And so when I'm working with entrepreneurs and investors, I go, listen, do you want to invest using life insurance, or do you want to store and use your money and then invest in things that you understand and can get maybe a better rate of return? And if any of them are interested in investing outside, I would feel more comfortable with the safe and secure, boring old whole life insurance that's max funded. We're still taking boring old life insurance and making it where 99% of you have never seen before because of how we're designing it. And you can still do the same thing with IUL. I just personally, if I'm going to do an IUL policy, I'm going to look at it as an investment. And I just don't think insurance and investments work well together. That's just my personal opinion. That's where I agree with a lot of our friends, where it's like, don't invest in insurance. I personally don't think long term insurance and investments married together are going to perform well. And so I would rather just separate them and really try to maximize the feature. But I have a lot of good friends who use IUL, and when set up properly, they have the potential of being really good. You just got to really make sure you understand them, and you got to make sure that you fund them properly, and you just have to make sure that you stay up to date because there are a lot more moving pieces to it.
Yeah. And I think early on for a lot of my students, it's really understanding the difference between like investing versus saving money in strategic places. Like really kind of hearing it over and over again allows for them to really separate their mindset of thinking that this cash is immediately for me to just go back and reinvest into something. Like I'm storing this cash there. Yes, I have the ability to go reuse it, but it's really, like you said, an asset. Can you talk to me about some of the principles that you teach on when it comes to storing cash, building wealth? What are the things that you kind of pride yourself on and things that I want to leave my audience with here today?
Yeah, so I think the twofold. Do we have time? Can I show a quick numbers illustration?
Yeah, you ready?
Okay, yeah. So let me show this. So this is a typical. I know there's a lot of numbers, and I'll explain it here in a second. So this is a policy where we're putting $50,000 in, and how much cash value do you have in year one? You have zero. You have a $3.9 million death benefit.
Okay.
Year two, you're putting $50,000 in, you have zero cash value. Year three, why am I showing this? Because when you Google, should I put my money into life insurance? A lot of people will have really negative things to say, and they should, because a lot of life insurance is garbage. You put a ton of money in, and yes, over time, you have $2.8 million at the end and $5.8 million of death benefit, but it takes so long to even get your cash moving where it's slow moving. And so I want you to remember the 2.7 million and then the 5.8, because what I'm going to do is we're going to look at the same type of policy. We're going to add what's called a PUA rider, a term rider. And what we're essentially going to do is get a lot more cash, a lot more flexibility, and get paid a fraction of what we would get paid. Okay. So the same policy, instead of having zero in the first year, we have almost $40,000 in the first year. Think about the difference. This is the same company. The only difference is how we maximize the contract. That's the only difference. You get 40,000 versus zero. Just think about the ramifications of that. And I'm not even saying this is the most powerful way to design. I'm just showing the quick example. Instead of it taking over 12 years to have all the money that you put in, this is after 6 years, you have more money than what you've put in. And at the end of 30 years, instead of having 2.8 or 2.7, you have 3.2 million. That's $400,000 more and the same amount of death benefit. So all we're saying from a standpoint of knowing, like, just know that you need to make sure your policy is designed properly and working with someone that understands this, because you can take the message and it can be radically different. And that's what we try to specialize in. From a standpoint of storing money, I have this thing. It's also very complicated, but what I try to do is I try to get a lot of different benefits that we should value, like safety, easily accessible, growth, leverageable, guarantees, all these. You can read the screen. And what I try to do is saying where you put your money, what are some of the benefits that you're getting? So we could put real estate up here and other things. And a lot of times you get trade-offs. There's trade-offs of where you put your money. Life insurance, the biggest trade-off is you don't get a tax deduction going in. And I put competitive growth because we know that we're not comparing to real estate. We're not comparing to investments. We're comparing to storing your money. So I believe life insurance gives you so many benefits if you understand with this paradigm of we're storing and using, we're not investing. So this is the thing that I like to share, because savings accounts are great, but the big problem with savings accounts is it's not getting you long-term growth. There's a big long-term difference, and the difference between life insurance and a savings account could be $500,000. For me, it's going to be about a $1.5 million difference if I store and use my money in a savings account versus your policy. I don't know about you, but that's a big difference. That's not an investing. Like, a lot of people are lucky to have investments at 1.5 million. I'm going to have an additional 1.5 million just because I'm saving my money in one paper asset versus another. It's not going to mean like I'm investing in other businesses and real estate and other things along the way. That's going to hopefully have a lot more than 1.5 million. I'm just saying where you store and use your money matters. And the last example that I'll use is, when we talk about life insurance, we talk about it as a multidimensional. We give your dollars more than one job. I use the cell phone example of saying we all have smartphones. And the reason is our smartphone does so many things. It wakes me up in the morning. It's my GPS. I'm able to call and text. I'm able to video and all these things. It gives us so many things. None of us look at our smartphone and say, this is an investment. Like, what rate of return is my smartphone giving me? We all have it because we know it's foundational to all the things that we do. My pitch to understanding life insurance well is, if you understand it, you're not going to compare it to investments. You're not going to compare it to the S&P 500. You're not going to compare it to the real estate market. You're going to understand that when it's at the foundation, you'll have lifetime growth. You'll have control. It'll give you options in the future. It will protect you. You'll be able the ability to save more. Like I was as an entrepreneur early on, I was able to save a lot of money because I had control over it. And that's really the message: is how can we enhance you as an entrepreneur? How can we enhance you as an investor? And how can we help you show up more powerfully? And this is really it. It's the iPhone, or God forbid the Galaxy, the Google phone to your financial life. It's not a replacement. It's really, I think it's really essential if you understand the power of it.
Yeah. And we have a really great question coming in from Jesse Hernandez. Jesse, thank you so much for sending in the $2 for asking your question. He says, does borrowing affect the death benefit? Caleb.
Wonderful, wonderful question. So let me go back. I mean, this is the beautiful thing about you guys being live here is, okay, so check out this policy here. So let's say at the end of 30 years, I have $3.2 million of cash value and a $5.8 million of death benefit. Okay. So let's say I take a $800,000 loan in 30 years. So I take the $800,000. Okay. If I die, or if I choose not to pay it back, the death benefit gets paid minus what I owe. So for example, if I took an $800,000 loan and I passed away or chose not to pay it back, when I pass away, my beneficiaries or legacy is going to get the 5.8 million minus the outstanding loan. So taking a loan affects the death benefit if you don't pay it back. But the other thing that I want you to know is the death benefit starts at 1.3 million. Every year your policy is increasing pretty significantly. So like when Dave Ramsey says when you use your policy, it steals from your death benefit, that's only happens when you have a traditional policy, because if you have a max funded policy, your death benefit is growing faster than your cash value. So while you do have less death benefit, your death benefits started at 1.3 and ended at 5. So let me know if that answers your question. So the answer is you have total flexibility, and when set up and used properly, your death benefit should increase at a higher rate than your cash value.
Love it. I love it. All right, we have some good questions coming in. I'm going to try to get one more question answered. Thank you so much, Jesse, for sending over the heart. We appreciate you, man. We have James Corio saying, so life insurance is like a savings account with better benefits, question mark. Caleb?
Oh, that is a perfect definition. When you're not going to see a lot of people teach this, because they're bashing all these other things and saying that it's going to save your marriage if you put money into life insurance. It makes me cringe, but it's a better long-term savings account that protects your family from day one. We didn't in this presentation get into any of the retirement benefits or any of the protection benefits, but just think of all of what I talked about and imagine some of the best protection now and in the future, and some of the best privacy and protections in the future.
Yeah, this has been absolutely amazing. Try to get to one more question. Let's see. Michael Hernandez was here early, so I want to get to Michael's question. He says, if you take out a chunk of money, let's say 40,000, can you replace that 40,000 back into your account?
Yeah, so I'm going to correct you on language because it's important. When you take out $40,000 and you borrow against it, your money never left your account. Okay. So yes, you can repay that. And it's just like a line of credit. When you repay, then you increase your ability to have access to more money. So the answer to your question is yes. If you withdraw that money, because it's your contract, you can do whatever you want. If you take that money out, you can't repay it. So our whole goal is, especially if you're young, taking loans give you tons of flexibility. It gives you options. And the Rockefeller family, they're an example of multiple generations having life insurance. It's all getting paid back to the trust, but they're using their money throughout their life. And then when they pass on, the money goes back to the trust, and every generation is better and better off.
Yeah.
So it's just an example of, hopefully that explains your question, but that's a great question.
We're going to have you come back on and teach eyelids. And
and then also like Ernst & Young just did, and Ernst & Young,
yeah,
they just did a study. They hate they don't love the life insurance space. They literally just did a study that said life insurance and investments give you better retirement income than one or the other. Dude, if people just understood that, even if you're not an entrepreneur, a portion of your assets should be in life insurance, it should replace your bonds. you would be better off having max funded life insurance like what I show versus have your money in bonds. So I believe, regardless if you're not, I'm speaking majority to entrepreneurs and investors right now, but even if you're not and you have 500, $1 million in a 401k, portion of that should be in life insurance and will just enhance your income. So it's just like, it's a message that needs to continue to be shared.
I love it. And I appreciate you sharing the message. Caleb, where can everybody follow you at?
They can go on YouTube, and I'll make sure it's tagged. It's Better Wealth on YouTube. And then also the big thing, Karlton, is we're giving our best stuff to your audience. And if they go to betterwealth.com/Karlton, it's betterwealth.com/Karlton, they're going to get all of our free trainings. I have a 61-page handbook that I go in depth into this. We have a 6-part video training. We have some of our best content, and we're giving it all for free to your audience just because you guys are amazing. So they can check us out at betterwealth.com/Karlton, or they can, and it's not about or, and they can go subscribe to our channel, Better Wealth. And it would be amazing to get some new subscribers and new family.
Guys, if you're a subscriber of mine, I want you to go ahead and jump over to Caleb's channel, hit the subscribe button. This guy is absolutely amazing. He's not going anywhere. He's going to be in this space for a very long time, just like I am. And you guys heard it. If you guys want access to some of this free content, you guys want to chat with the team to learn more about this, I will post the link below to betterwealth.com/Karlton. So you guys have the ability to get more information as it pertains to life insurance. Caleb, so happy to have you on. We're going to bring you back on. There's more that we need to discuss. I feel like we're literally just touching the tip of this stuff. I want to go into individual life insurance trusts. There's so many different things that I want to talk about. I have clients that have brought up captive insurance. There's just so many things that we need to discuss. So when we bring you back on, we're going to go even deeper. And I just want to say thank you for your time today, for being on with us.
It's a pleasure, Karlton, and the best is yet to come. So I look forward to future combos.
Absolutely, brother. You have a great rest of your day. Take care. Guys, thank you so much for joining us today. This has been absolutely amazing. I think we need to do more lives like this. One thing is for sure is that you guys are an amazing audience. I appreciate the engagement inside of the chats. I will make sure that you guys have the link inside of the bottom of this video. It'll be somewhere down here. To everyone else, have a wonderful rest of your week. I will see you guys back on here next week when we decide to do this live again. Thank you guys so much for your time today. Talk to you soon.